In 2025, Bitcoin is not just a digital currency. It is becoming the centerpiece of institutional investment strategies and global macroeconomic discussions. As markets navigate inflation, shifting interest rates, and geopolitical risk, Bitcoin is quietly stepping into the role once held by gold, but with even greater upside potential. Let us take a deeper look at what is really happening beneath the surface of this cycle and why Bitcoin matters more now than ever. The global economy is in a period of realignment. Central banks, led by the Federal Reserve, are signaling a cautious approach to interest rate cuts. Inflation, though softened in some regions, remains persistent in services and housing sectors. Meanwhile, traditional assets like equities and bonds are showing increased correlation, reducing their effectiveness as portfolio diversifiers. In this uncertain climate, institutional investors are looking elsewhere, and many are landing on Bitcoin. For them, Bitcoin is no longer just a speculative asset. It is a macro hedge, a store of value, and in some cases, a strategic reserve asset. But before we get into that, let us briefly revisit what Bitcoin actually is. Bitcoin is a decentralized digital currency that operates without any central authority or middleman. It runs on a global peer-to-peer network, secured by cryptography and powered by miners who validate transactions. What makes Bitcoin especially unique is its fixed supply. There will never be more than 21 million coins in existence. That scarcity, combined with transparency and security, positions it as what many now call digital gold. And institutions are starting to agree. In 2024 and early 2025, we saw a major shift. Asset managers, sovereign funds, and public companies began allocating a portion of their reserves into Bitcoin. The approval of spot Bitcoin ETFs in multiple regions, including the United States and parts of Europe, opened the door to more regulated, accessible exposure. Some governments are even considering including Bitcoin in their strategic asset reserves, a move once considered radical. On-chain data backs this up. Wallets holding large amounts of Bitcoin, so-called whales, are increasing their positions. Institutional custodians like BlackRock and Fidelity are facilitating massive flows into Bitcoin-related financial products. And with the halving now behind us, the supply dynamics are tightening, just as demand from large players begins to surge. But let us be clear, Bitcoin is still volatile. Its price can swing by double-digit percentages in a single week. It reacts strongly to macroeconomic news, regulatory developments, and shifts in public sentiment. And it is still misunderstood by many in traditional finance. For retail investors and institutions alike, this means one thing. You must have a clear strategy, understand the risks, avoid short-term emotional decisions, and focus on the broader picture. Because what we are seeing in 2025 is not hype, it is structural adoption. Bitcoin is maturing, fast. It is moving from the fringes to the financial mainstream. And as that happens, early strategic positioning could define who wins the next decade of digital finance. So what should you do now? Start by learning. Track the macro signals. Follow the on-chain data. And view Bitcoin not just as a volatile asset, but as a piece of a much bigger shift in how the world defines value. If this breakdown helped you see the market more clearly, subscribe to Crypto Wayfarer for weekly insights into crypto, macro trends, and investor psychology. Like the video to support our research, and comment below, how are you positioning yourself around Bitcoin this cycle? Until next time, stay informed, stay strategic, and stay wayfaring.